For the conclusion of our Chapter 9 video lecture, we're going to prepare a planning budget and a flexible budget, but this time we're going to have more than one cost driver. Again, recall in our previous budget, it was predicated upon the number of lawns that we cut within 1 month. Okay? So now Larry has revised his budget. So with a multiple cost driver, we feel that more than one cost driver may be needed in order to explain all the costs in an organization. So we're saying that just knowing how many lines we're going to cut is not sufficient in order to understand all the costs. So we're going to add at least one more cost driver to our formula in order to capture all the costs that took place during the accounting period. Okay? So Larry decided to add an additional cost driver, which is going to be hours. The amount of hours spent on cutting these lawns. Larry understands that for the different lawns, it takes a different amount of time to do the edging and trimming for these different lawns. So we're saying not just how many lawns did we cut, but how many hours did we spend cutting these different lawns. So now we're going to have two cost drivers in our formula. We're going to use the number of lawns cut as one cost driver, but we'll also use the number of hours that we spent cutting these lawns as a second cost driver. Okay? So here is our revised planning budget. Notice for the revenue, we're taking $75 per Q. Q stands for number of lawns, plus $25 per hour that we spend on cutting the lawns. So again, we have a new revenue formula. We take $75 per lawn that we cut as revenue. We also estimate we're going to add in $25 per hour that is spent on cutting the actual lawn. So we've changed our revenue formula for Larry Lawn Service. Same for our expenses. We still have the $5,000. That's a set amount. That's Larry's annual monthly salary. We're still looking at, now notice that at first it was $30 per yard. We revised it to $29 per yard as an expense, and also $25 per hour has been added to the actual wage and salaries. And so that would explain why we had a higher variance, because at first we did not take the number of hours spent cutting these yards under consideration, but now we added an hourly rate of $25 per hour into our expense budget. We also changed our gasoline supplies and equipment maintenance formula. We've added hours because we're saying the longer it takes us to cut, the more gasoline supplies are going to be needed. That will also make, the more we use the equipment, we're going to also have more equipment maintenance. So we have revised our budget to include now not just how many yards did we cut within the month, but also how many hours. So we estimate we're going to still cut 500 yards, and that it would take us approximately 100 hours to cut those 500 yards. So now we see our estimated revenue on our planning budget is $40,000. Total expenses, $34,300. So based upon this planning budget, we estimate to have a net operating income in the amount of $5,700. Okay? We'll now compare our planning budget, use that information to prepare our flexible budget. Okay? Now, based upon producing 550, or not producing, based upon cutting 550 yards, we're going to show a new formula. All right? So we'll take the 75 times the number of yards cut. Our rate is still $25 per hour in revenue, and that would give us our total revenue under our flexible budget. We're going to add the number of hours to our wages and salaries at the same rate. So pretty much you see that this has just been passed on to our workers, that $25 per hour, but we are accounting for it now. So you take a look under our flexible budget, we expect total expense to be $36,250. Therefore, by producing, or I keep saying producing, by cutting 550 yards, we should have a net operating income of $7,500. Okay? So once again, we're going to do a comparison. We're going to compare the actual numbers against our flexible budget and our planning budget, but now we have the additional cost driver. Okay? So overall, what we're saying is that based upon our flexible budget, we should have earned $43,750. However, we only earned $43,000. But take a look at the number of hours. What we're saying is that it should have took us about 100 hours to cut those yards. Look at the actual hours. It actually took us 200 hours, double the amount of time that we expected to cut those 550 yards. So one of two things. It could be a training issue, causing the time to be double what was expected, or maybe the number of hours that we expect was not really realistic. So I would strongly recommend that we take a hard look at our formula for the number of hours we expect to cut these yards, because again, it took us double the amount of time that we expect to cut those 550 yards. So that would explain why we end up with an unfavorable variance when it comes to wages and salaries, gasoline supplies as well, because once again, the longer it takes us to cut the yards, the more gasolines and supplies are going to be used. So based upon our flexible budget, our profit should have been $7,500, but as you can see, the actual profit was $6,450. Is unfavorable by $1,150. So it's unfavorable because the total revenue earned was less than what was expected based upon our formula. And then we had some increase in expenses for wages and salaries, gasoline, insurance. So again, this budget allows us to evaluate things. Take a look at our planning budget, our formula, to see if those amounts are really realistic, or again, do we need to increase the number of hours that we expect us to take us to produce these units. So remember that we know we had 100 for 500 and we use the same number for 550. Typically, we'll use that number within a relevant range. But is it realistic to think that you can cut 50 more yards in the same time period? So again, Larry might want to rethink that number for the number of hours expected in order to cut so many different lots. Okay, so I hope you've enjoyed this chapter on flexible budgets, where you're comparing your planning budget against your flexible budget against your actual budget. So why don't you do this for me, or do this for yourself actually. why don't you prepare a planning budget for yourself to show your expected revenue coming in for the month and your expected expenses, and then compare that against your actual revenue and actual expenses to see whether you have favorable or unfavorable variances. Okay? All righty. Have a great day.